let's kick off with talking about the marketplace. I mean, it's a good time to be in gold and it's a good time to be in uranium. Now, not for all the wrong reasons, obviously. No one wants COVID-19 to go on much longer, but
No.
you guys have seen a huge set of catalysts over the past few weeks. Obviously, with Cigar Lake, Kazatomprom closing down, Namibia shutting down. I think Australia seems to be pottering along. What's your take on the market conditions and what it's going to mean for people like you?
Yeah, absolutely. Well, look, it's sort of hard we shouldn't dance around the fact that this is a terrible time for humanity, and but of course it's an ill wind that brings no good. And in our particular case, what we're seeing is exposed is the very challenged nature of the uranium supply side. So, there's about 441 nuclear reactors operating around the world. So good, strong demand and diversified demand there. And then on the supply side, there are 12 uranium mines that supply over 80% of the world's uranium fuel, nuclear fuel. So if one of those mines goes down, particularly one of the big ones, then we see some real challenges exposed. Of course, what we've seen here with Kazatomprom, world's biggest producer, and Cameco closing their last operating mine, Cigar Lake. You've seen 60% of global production removed from the market in one fell swoop. And of course, what we've seen in the past couple of weeks is just the announcement of those closures has been enough to drive the uranium market into a serious bull market. We've seen the price rise from $23.50 a pound to $32 a pound today. So that's up a little bit over 30% simply on the announcement. That's before any of that product's been removed from the market. I think that product is disappearing from the market this week. So I think the setup's a really, really interesting time. We could see uranium price really spike, and then it'll come down to what happens with the utilities, how they respond. We've heard that Kazatomprom have told the traders, those guys that sort of operate in that carry trade market, there's no product available for them anymore. So they're starting to not panic, I suppose, but really get concerned that they're not going to get product to keep their business going. But when the utilities, when those complacent customers, particularly down in the US, start to see that there's no product, and of course these guys have been very well supplied. They've been open about this. That guys like and Mike Alkin at Satcham Cove have been very eloquent on this topic. There's been enough product in that spot market for them for the past 3 or 4 years that they haven't had to go beyond that and think too hard about where their supply is going to come from. Well, all of a sudden that's been turned on its head and it's sort of too late for them. So I think, we've got to find out where we stand in terms of fungible, tradable, accessible stockpiles. We suspect there isn't much out there because the utilities don't have big stockpiles and the producers don't have big stockpiles. So where are these things? But we'll know that in the next couple of months as the product disappears from the market. But, I think there's every chance. Now, in all likelihood, I think we'll see stronger prices as the product disappears from the market and those utilities come back into the market looking for that spot product. But what happens in 3 or 4 months' time when they find that there isn't much out there at all? Do they start to panic? Do we see a 2006, 2007 type scenario where the uranium price goes from $30 all the way up to $150? I wouldn't bet on it, but the risks in the whole market here are to the upside for the uranium price. So it's terrible time globally, but for the uranium sector, it could not be more bullish. It's going to be a fascinating 2020.
Well, yeah, it definitely is. We spoke to John Borshoff yesterday. He's obviously got a very different business model from a lot of the junior explorers because he's reliant on his M&A strategy working. And I guess one would argue, and I think he was, sensible enough to admit that he's going to talk his playbook. But his view was that the price of uranium would get up to 35, hang around there for a while, and then drop back again. Because we don't actually know what the utilities are going to be doing. They might be feeling nervous, but are you seeing or are you hearing anything over and above? You said Kazatomprom have contacted a few traders to say that there's no available spot. Are you? What else are you hearing from utility companies? Because I know you've got NextGen who works quite closely with you. I think they spend a lot of time and effort talking to utilities. So what do you know? What are you able to share with us in terms of some of the behaviour from the utilities this week or last week?
Yeah, well, look, we've heard a little bit. I think I heard, a couple of days ago that Duke in the US have said that, COVID-19's changed their view on supply dramatically. So they're sort of, I think they're well aware of what's going on. I think the other thing that's worth considering, and John, John's a friend, and I've got the greatest of respect for John. He's a legend of the industry, of course, a larger-than-life legend of the industry. I think we've heard as late as a couple of hours ago that Cameco are talking about the decision to take Cigar offline was a health and safety-related decision. The decision to bring it on will be a commercial decision. I know there's a conference call with TD Bank, Cameco now, so it'll be interesting to see what comes out of that. And then we understand, Kazatomprom, of course, are in a tricky position because the former Soviet Union countries, their permitting regime requires that they produce at their nameplate capacity and follow all of legally must follow all of the stipulations in their subsurface use licenses. And in their particular case, they haven't been able to cut production to the extent that they want. And we understand that there's some sort of agreement with their government that they can now use this period to really cut back their production. And of course, they've taken, they do supply 40% of the world's uranium. And they've taken all of that offline in one go, and it's offline for at least 3 months. So I hear what John's saying. I suspect that we'll see prices go much higher than that. And what we do know is that those, particularly Cameco, have been very open about saying they need to see $50 plus uranium before they'll start writing long-term contracts. So I think that's where we go.
Well, let me come back to something you said earlier. So you said Cameco took Cigar Lake offline for health and safe reasons, health and safety reasons. They will not put it back on, or they'll only put it back on for commercial reasons. What do you think they meant by that? Do you think that means they will be looking for the market to find the right price, or do you think it's going to mean something else entirely? I mean, what should I read into that statement by them?
Yeah, look, and this is all sort of.
In which case, to me, that's kind of price fixing.
Position at the moment.
It's kind of price fixing it, isn't it? In a way, holding the market to ransom.
It's not, because of course we do know that their all-in sustaining cost is considerably north of the price at the moment, and they've been very clear to tell the market that they're not going to write any long-term contracts for unless they make profit on their what they consider tier one assets, which is absolutely fair enough. And I think our suspicion is that they've been losing money on that production. Of course, a good chunk of their business has become buying product in the spot market for $25 a pound and selling it into the few long-term contracts that they've got left at $40 to $43 a pound. So that's been a good trade for them. But I suspect that, they really need to see certainly north of 45, but I think we've heard $50 a pound. They're not going to write long-term contracts until they get to that price. So it's not market manipulation in any way. It's just simply putting your production on hold until you get a price that's sustainable for your business. And I think, we all know that the production around the world, we've seen plenty of those cost curves. There's no great cost curve in our sector because we, for whatever reason, we still don't quote all-in sustaining costs, but we know that, the cost of production in our sectors are considerably higher on average than the spot price has been for the past couple of years. So everyone's got to see a much higher price. And, this period of time is simply a readjustment back to more of a sustainable price.
So both Kazatomprom and Cameco are going to take the opportunity to withhold production into the marketplace until the market finds a price at which they deem they can get back into the market. But that's going to be at a much lower rate than most companies are going to be able to consider getting into production. We've talked to the US producers. They're talking 55, 60, higher, right? So again, it could have the optics of the two large players, 60% of the market, controlling price to suit their needs, but it's not going to do much for the people who kind of, the tier 2, tier 3.